Thank you very much for joining us. To anyone that doesn't already know me, my name is Daryl Hulse. I am one of the Wealth Associates at Sawa. So really great to have you all with me tonight, and I'm really looking forward to discussing the very important 4 rules of investing. And hopefully the information that I'll be sharing you'll find useful, and even if you're not already an investor, you'll help it to embark on your journey. So it's actually quite interesting because I feel like the times we're seeing today have really made people stop and think about today's situation and both their present and their future. So it's highlighted what's really important to people, and I think it's changed what they value as well. I spend a lot of my time on the phone day to day with so many different kinds of people, which I do really enjoy. I speak to people from various different countries, nationalities, and they all work in, different industries, from hospitality, engineering, interior design, of course, finance, and retail. Some are young, some are old, but the general consensus at this time is the same. Everyone that I've been speaking to has been thinking more around their financial security, putting money aside for a rainy day and those unexpected emergencies, as well as seeing the need to look after their future self and their families. I don't know whether this is just because they've had more time on their hands perhaps lately, or whether they are starting to realize the importance of savings and investments, but we'll definitely be taking a look at that. All right, so if everyone is ready to get started, today we'll be talking about the 4 rules of investing and really what you should be looking to do before you get started on that journey, as well as some facts to keep into your mind as you move along, and hopefully you'll be able to then focus on your long-term goals. So just a couple of disclaimers, because unfortunately we can't tell the future here at Sawa. Just like you, we don't have a crystal ball, and my views tonight shouldn't really be interpreted as one-on-one financial advice. It is just general guidelines. If you do want one-on-one advice, you can contact us anytime and we'd be happy to chat. So the first thing I'd like to touch on is what we call the 50-20-30 rule, or the 50-30-20 rule, I should say. We're starting with this because whether you are already investing or not, you want to have an idea of what your household budget should look like. And as a general rule of thumb, experts suggest that firstly, 50% of your monthly salary should go towards our needs. So the necessities that we need day to day to get by. This might be our rent or mortgage payments, our groceries, healthcare is a big one at the moment, as well as transport and other things. Then we should allocate 30% of our salary towards ourselves and the things we enjoy. So I know for lots of us at the moment, that might have changed what it usually looks like. I know maybe Netflix is on heavy rotation at the moment with online shopping and some other fun subscriptions. For example, recently I downloaded Rayman on Xbox, which is sort of a kid's video game. And I haven't played that since it was released on PlayStation 1 about 20 years ago. So it's things like this that we're getting back into, and wants that have really seemed to have changed over the past couple of months. If you have any random things like that, by the way, that you've been doing to keep yourself occupied recently, then pop them in the chat, as it would be great to see what people are getting up to. Anyway, I digress. So lastly, 20% of your monthly salary should then be going towards your savings and investments. It's important to note that before you embark on any kind of investment journey, it's really important to make sure that you've paid down any high interest debts and loans, as well as set aside an emergency fund. Ideally, this should be between 3 to 6 months of your expenses, so that you can pay them if any emergency arises. Okay, so let's take a quick look at what is happening today. There's a saying that goes, the best time to invest was yesterday. But recently, people have been saying to me over the phone or video calls that they would prefer to wait to get started until the times are more certain and the volatility is calmed down. Of course, I do understand that in these times of economic stress, the markets tend to be more choppy and these big market swings can cause anxiety in a lot of people. But we have to understand at the same time that volatility is the nature of the stock market and it stems from uncertainty. Now, whilst we can't predict the future, there are lessons that we can learn from the past. And if we take a look here at this next chart, this depicts the world's strongest market. So we're looking at the US. And if we just take a look closer, I know it's a bit small, so sorry if you can't see it, but this dates back between 1930 all the way through to 1990. And we'll see here that the markets have weathered many significant events over that time frame. Now, the key takeaway that I really want to drum in here is that despite all of these major events and the short-term setbacks, the overall market trend has been upwards. Whether it's, take 1962, the Cuban Missile Crisis. The world at that time was on the brink of a nuclear war. That was an uncertain time. Or even if we look more recently, we had the Chernobyl disaster. Brexit was a big one in 2016. Donald Trump being elected in the US, the dot-com bubble, all of these significant events. As we'll see from the green line, when we were living at those times, they really did seem very significant, but the market recovered just fine and it continued on its upward trend. So please try to ignore all of the daily headlines around the coronavirus, the oil prices at the moment, because the media does have a tendency to focus very much on the bad things. Try not to get in your head too much and prevent you from starting your investment journey, because over the long term, you should be just fine. One of actually the biggest investment mistakes that we see is that people just don't get started. They fail to participate in the markets, whether that's the stock market, bonds, or any other kind of financial asset, could be real estate, for example. But they either, number one, simply never get started, or number two, they're not always investing because they're trying to time the market. And we'll get up to more on that later. But ultimately, this costs the average investor around 4.3% every year. So it's really important to start your investment journey as soon as you can, make time your ally, and stay in the market as long as possible. So we're going to deep dive into the first rule that we have, which is to start now. And as we've already touched on, it's a really key part to your overall plan. Now, this is a quote from Albert Einstein. I'm sure many of us this evening are familiar with him. He was once quoted to say that compound interest is the eighth wonder of the world. And there is a reason that compound interest is referred to as such, because it does have such a snowball effect that happens on your earnings. And it basically is when your interest starts to earn interest on itself. So how much your money can grow over time is going to be partly determined by how long you have in the market, and ultimately the longer the better, because you'll benefit from more compounding periods. So this is a nice chart to just show this. And we can see here that if we invest $10,000 only, if we compound that annually at 5%, it would actually end up being worth over $40,000 after a 30-year time period. So in compound interest alone, you're actually gaining around $30,000. So that's a pretty significant amount given that you're only investing 10. So it's something that you really want to take advantage of. Leave your money alone as much as possible. And if we apply this to a simple real life example, we can take two friends. They're called Gina and Raina. And we can see here that if they start both investing $5,000 a year, every year until the age of 65. We can see that Gina, who is 25, and therefore starts investing 10 years earlier than Raina, at 35, she ends up with a nice round $200,000 compared to Raina's $150K. So that's a big difference, right? $50,000. But if we then apply the impact of compounding, we'll see that that 10-year small difference really in the scheme of things actually translates to over $500,000 that Gina's adding to her portfolio. So we're talking doubling your money. Pretty crazy. And that's why they call it magic of compounding. Alrighty, so market timing, another big one, factor that we're going to spend a bit of time on this evening because it's very, very tempting for people to want to time the market, as you understand that everyone wants to maximize their returns as much as possible. So people either don't start investing or they delay their future contributions because they fall into the trap of trying to time the market. And they believe that there is this perfect time. So as mentioned, we all want to definitely maximize the amount of returns that we achieve. And in a perfect world, we'd all be able to predict exactly how the market is going to react in order to buy and sell at the best time. But in reality, it's just not that easy. So what we're seeing here is a chart which shows the performance of the S&P 500 between very recent 11th and 13th of March. And we'll see that the market's dropped 9% and recovered 9%, all in the space of just 2 days. So this is really how quickly things can change. And it's very easy to just miss those rebounds and the opportunity to profit from these movements. We also actually conducted a study here at Sawa to analyze what happens when you try to time the market, and considered a number of different scenarios, as we can see here. So we looked at what would happen when the market was to drop 30%, and then we reinvest when the market slightly jumps just 5%. And then again, a comparison of the 10% reinvestment versus a 15. So if we take a look here, the early bird often gets the return. Now, when we analysed the performance of all of these different strategies, we considered a 30-year period ranging from 1990 through to this year, 2020. And then we compared them to simply staying fully invested in order to get a better understanding of the impacts of what pulling out of the market can have versus staying in cash, even for a couple of days. So if we look here, you'll see that the simple strategy of staying invested throughout significantly beats the other strategies we explored. In some cases, the difference in performance is substantial. If we take our focus to just scenario 3, where the hypothetical person exits when the market drops 30% and then re-enters after it rebounded 10%, then you would have actually earned 21.5% less than just by simply staying in the market. So this major shortfall occurs after only just 33 days out of the market in total. Now, I must really stress that point because it highlights how exiting the market for even just such a short period can really greatly harm the performance of your investment. Now, obviously, this is just one time horizon, and the markets have been around for years and years and years, decades, centuries. So we did also take into account other time periods. We looked at from 1970 onwards, for example, post-World War II and post-2000. But each time, the results came back with very similar conclusions. So the takeaway from this that is important is that at best, market timing doesn't work, and it's extremely difficult to do, especially on a consistent basis. A lot of the time, really, it's just based on speculation and a bit of luck. when really there's no need for us to overcomplicate things. Investing doesn't have to be difficult. It's as easy as investing and leaving it alone for the long term. Of course, if you are properly diversified, if you're experiencing, on the other hand, perhaps an investment that is consistently underperforming, then you might want to reevaluate your decisions, of course. But if you're diversified properly and you know that the market's likely to recover, you're much better off just leaving it alone. There's an analogy that I like. I don't know who the quote is from, but they say that investing is like a bar of soap. The more you handle it, the smaller it gets. Also, something to note here is that stocks often rebound very quickly, and they generate their biggest gains during these times. They come in quick bursts and often very unpredictable and almost impossible to time. A great example of this is the recent coronavirus comeback. So as we are all very familiar with today, the S&P 500 actually lost around 30% through Feb and March, but almost immediately it's recovered a significant amount of those losses, and as of close last Friday, the S&P was trading almost 30% higher than the low seen on the 23rd of March. So this is just really to highlight not to panic and let, again, those news headlines get into the forefront of your mind, and know it's very difficult to get away from it when it is splashed on the front screen of every day and it's anyone is talking about, but try not to let it take your focus away from your long-term plan. So I've tried to make it as clear as I can that no one can time the market properly, but let's just say you want to try it out. You're one of these people that can't just take my word for it. You have to make the mistake yourself before you'll learn, which is fine. So let's just take another example and say you put all of your money into the S&P 500 between, in this case, it was 1996 to 2015. If you had just left it in the market, tracking that index, you would have ended up with returns of just over 8%, which is about right. However, because you wanted to try and time the market, you might have taken your money out, and had you missed just the top 10 trading days, that's the top 10 in the entire 20-year period, then you'll see from the second bar on this chart that your returns almost halved. So just let that sink in for a moment. That's if you miss the top 10 trading days in 20 years. Imagine how easy that is to do. Then if we look on, we'll see that if you then miss the top 20 trading days, the top 30, top 40, your returns decrease until eventually you end up in negative territory. So let's try to ignore the noise, whether it's the negative press, Facebook, or your friend's brother who said that he works in finance, and try not to let it affect your sound investment strategy. What we want to be doing is having a plan in place that we can take action on, be decisive, and agree that there's no perfect time. So that's it for rule number one. And rule number two we'll be getting into is don't pick stocks, but diversify. I'm sure some of us will have had experiences in trying to pick stocks in the past, myself included. And I generally know that picking stocks, you tend to have general analytical skills, maybe be good at math, a strong amount of knowledge about the individual company as well. So you want to be reviewing things like the balance sheet so that you can understand the value and assess their cash position. You also need to keep on top of daily market news, trends and events that drive the economy and therefore have an impact to each of the individual companies that you're investing in. That way, you'll then know when to buy and sell. But it's all very complicated, and even the professionals most of the time find it very difficult to keep on top of all of these moving variables. Most of us regular Joes like you and me just don't have the time knowledge or want to properly understand all of these elements before we invest. As a result, the majority of us end up losing money a lot of the time, and even when something seems like such a sure thing, it usually isn't. And a great example of this is everyone that invested into the internet back in the 1990s. Then we had the dot-com bubble in year 2000, and it just wasn't what everyone thought it was. So you might be thinking at home, well, what do I do instead? And there was a quote by Harry Moskovich, who is a famous economist. He was once quoted to say that diversification is the only free lunch. So what does this mean? What he's essentially saying is that by properly diversifying, an investor can benefit from reduced risk without having to sacrifice any kind of significant returns over the long term. So diversification is a key part of anyone's investment strategy, and the easiest and cheapest way to achieve this goal is usually through exchange traded funds. So you'll see here that an exchange traded fund, or an ETF, is simply a basket of securities bundled up into one product. In simple terms, it really allows you to buy a large number of shares in bulk at a very low price. So to show the benefits really from diversification, we've got a chart here that shows a number of different asset classes and their performance from 2005 through to 2018. Now, I'm not sure about you, but to me, this looks kind of like a roulette table. Now, if we pick just one, let's look at the purple square on 2007 at the top. This represents how emerging markets performed throughout that year. So we'll see that if you invested all of your money into emerging markets in that year, you would have ended up very happy with around 40% in your pocket. Perfect. But unless you knew exactly what was going to happen next, you would have quickly found yourself at the back of the pack in 2008 with negative returns of over 50%. So this is really just to demonstrate that it's extremely hard to know what's going to happen next and to try and consistently buy and sell at the right time. Instead, rather than pick single stocks, what you want to try and do is spread your money everywhere. And as a result, this will help you to spread your risk, and some will be moving up or down in what's called uncorrelated assets, meaning not everything is moving in the same direction at the same time, which will help you to limit losses during periods of high volatility. The reason that this is beneficial is because if you're spreading your money across the global economy in a number of different sectors and asset classes, then the global economy overall should perform well. Alrighty, so next up, we have a great example of a bet that was placed by Warren Buffett in 2007. So he bet $1 million against a collection of hedge fund managers that the S&P 500 index would outperform them over a 10-year period. Now, for those of you who don't know, a hedge fund is one of the most actively managed type of funds available. They use complicated trading strategies to try and know when to buy and sell, and they manage millions and millions of assets under management. They're meant to be the best of the best. Whereas a passive investment, like an ETF, it simply tracks and matches the returns of the underlying market over the long term. So it rides the highs and it rides the lows. So anyone that didn't know about really the true difference between active and passive investing, I imagine would expect that the hedge funds would win, because they're the professionals, right? They spend their entire days studying the markets and analyzing what's expected to happen. Now remember, this bet was placed in 2007. And what happened the following year? Markets tanked. So At the end of the bet, the 10-year bet in 2017, it was actually realized, as we'll see from these key facts here, that the winner was in fact the S&P 500 by a significant amount. So the hedge funds weren't able to predict that significant downturn that we all experienced through 2008, 2009, and the S&P index actually generated their investors nearly 3.5 times the amount of returns than these top guys. Now, 60% of all of the gains achieved by the hedge funds were actually deducted because of their very high fees as well, which is something we'll come back to later. And despite those, they even underperformed on a growth level. So guys, be aware of the difference between active and passive investing, because statistically, and I think this is a quote from The Economist, over 90% of actively managed funds fail to hit their benchmarks year on year. So there's an increasing number of people moving into passive funds for this reason, as it's much less complicated and significantly cheaper. Alrighty, so rule number 3 is to keep your costs low. And this is a quote from myself: higher fees erode returns, so lower your costs. Please pay attention. This is a very important rule, and ideally as a benchmark, we want to be looking at 1% maximum for any investment option that we're considering. So before we get into it, let's just get to know the kind of investing costs that we should be looking out for, because there can be quite a few. There tends to be fine print, layering, but these are a few. So we see that stocks, bonds, ETFs, mutual funds all have different types of investment costs. The things to look out for include, in the red box, we've got expense ratios, trading costs, entry-exit costs, commissions, withdrawal penalties, collection charges, all of these different things. And these are just really to name a few. So the point is that you should ask any provider that you're sat across the table from and you're looking to invest with for a full breakdown of their fees and any associated costs. If the pricing structure is very complex or they can't explain it to you simply and clearly, this is usually a red flag. Here, this just is a quick chart to show you how investment costs can erode your returns. So if we invested, say, $10,000 with no additional contributions and left it to grow in the market over the course of 30 years, we can see that without any fees at all, it would grow to around $76,000. This is assuming, by the way, a 7% annual growth return, which would be around what we would expect for a growth portfolio. But obviously we can't, unfortunately, invest with zero costs. So the ideal annual fee we want to be looking at, as I mentioned, is the 1% mark. So what tends to be quite scary about the industry, though, is when we're talking about fees, it could be a very small difference, maybe between 1% and 2%, or even 0.5% and 1%. And when people are considering that, they tend to not understand how much of an impact that could actually have in monetary terms over the long term. And we'll see that even that 1% difference actually results in us losing around $18,700. What's even more scary is that us living here in the UAE, we actually live in one of the highest fee regions in the world. Often I see and do the analysis of people who are in existing investment plans with other providers here, and they're paying usually on average about 4.5% every year. And as we'll see from the last bar, that causes our earnings to drop from $76,000 to just $21,000. And that's really not uncommon. And the insurance companies that sell the investment schemes here in the UAE are prolifically sold very aggressively, and most expats have been contacted by them over the phone, if not investing. Now, this is just a very simple example, but hopefully most long-term investors would be making smaller contributions as well outside of that initial investment. So I just wanted to take a moment to bring your attention to more of a real life example as well. So what you'll see here is just a small chart with where we're starting with a modest 50,000. Hopefully, most of us have been working hard and saving already. So assuming that you've been able to start your investment journey with 50,000 bucks, and then on top of that, you were making regular monthly contributions of $1,000 for the next 30 years until you were to retire, taking the exact same annual growth rate of 7%. If we compare then two separate portfolios, one with fees of 0.85% per annum and another with 2% a year, we can see that we actually would end up paying a huge additional $300,000 in fees alone for the exact same product. And that's a very small difference of just 1.115%. And we can really see here how the costs start to eat into a significant chunk of our returns that we work so hard for. So steer clear of the sharks, guys. Understand your fees. If you don't, like I said, it's usually a red flag. So lastly, the thing I wanted to talk about, and this is usually the most favorite rule that I like to discuss with anyone, is emotions, because this is relevant to everyone in all aspects of our life. And it's very difficult to sit tight and stay in the market when everything seems to be getting out of control and market prices are falling. But the fourth rule that you want to keep in mind at all times is don't be emotional. There's a nice quote here which says, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. And this is because we get fearful, we panic, and we trade at the wrong time. So factually, a little quick fact here for you all is that the average investor earns below the market returns. And this was a study, I know it's quite an old study, but it's still very relevant, conducted by Daryl, who found that the average annual investor return over a 10-year period from, in this case, Jan 2006 to 2015 was 4.2%, compared to the average S&P 500 index, which returned 7.3% over the same period. So that's all down to emotional investing. Simple and pure. Just trading at the wrong time because we're struggling to keep things in check and control our anxieties. So this gap is what someone would call the behavior gap as well. So something to touch on is that it really is a bit of an emotional roller coaster. Most people go through so many different types of emotions when they come to investing. They move through a cycle of feeling very hopeful and excited as the markets are moving upwards, but then as the pendulum swings and things start to take a bit of a downturn, as they always do, then they might start to feel anxious. So here they might try to initially start reasoning with themselves and telling them, okay, I'm a long-term investor, it's all going to be okay. But then when the market might continue to move downwards, the logic starts to go out of the window, and that once happy and excited investor is suddenly gripped by panic, and they can't see that they're at a point of actual maximum financial opportunity. And it's quite funny because when we go shopping for clothes, for example, most of us like to look for a bargain. We're out on the hunt for all of the best deals. There's always sales here in Dubai. And I mean, given that it's Ramadan at the moment, I'm sure the shops are going to be full of sales again for Eid. So it's no different really when it comes to investing, that you should be hunting for the best price possible. But this is one area where consumers consistently pay higher prices and actively avoid the opportunity to pay lower prices. This is why I include a similar chart just here, as we like to use this greed and fear chart. It's a simple way of showing it as typical investor behavior. They buy into the market perhaps because they hear about a stock that's performing really well. It's been climbing higher and higher in price. Tesla is a good example of this in recent times. And then they get greedy. They want a bit of what everyone else has got. And if their friends are making money, they want to make money too. So what happens is they tend to invest more and more into a rising market. Then once the markets take a turn, they get fearful and they sell, which is the exact opposite to what they should be doing in investing, which is buying when it's low and selling when it's high. As we saw at the very beginning of the presentation, we had a depiction of market volatility over time. And we touched on the fact that there have never been times of certainty. So what we really want to do is not get caught up in these unprecedented times and believe that the market is too volatile or the current situation is too uncertain to start your investment journey. Coming back to this again, you want to block out the noise and just focus on the information that's really close to your heart, stuff that is actually going to be useful, rather than get caught up all in the news headlines. So what can you do to help you to control your emotions, you may ask? Well, the first thing is to take a deep breath and don't panic. And before you make any rash and illogical decisions, try to just rethink what your end goal is. And if your goals haven't changed, your financial situation hasn't changed, and your portfolio isn't consistently underperforming, then really you shouldn't be making decisions on the short-term market moves. So try to not check your portfolio every single day. You're in it for the long term, so just continue with your long-term plan, invest small amounts on a regular basis, regardless of what's happening in the market. It will eventually bounce back and you'll be just fine. Of course, a big consideration as well is your risk level. You want to make sure that you aren't stressing day to day about your portfolio. So make sure that you are comfortable with the volatility that's being seen. If you're not for any reason, you can look to dial down your risk. And also remember that you should speak to your advisor. That's what they're there for. They're on hand to talk you through and offer guidance during times like this, in order to make sure that you are getting the most out of your investments and staying on track. So this is just a recap before we go into the Q&A. And what we should be doing is getting started. So be in the market, stay calm and invested for as long as you possibly can. Don't pick stocks. Instead, diversify properly across different asset classes, within asset classes, and different countries as well. Then we want to stop being emotional as much as we can, block out the noise, and stick to our plan. Guys, if there's one thing that I'd like you to take away with you today, it's this snapshot right here. Because what we tend to focus on as investors is the things that we cannot control in the form of our returns. Often the first question I get when speaking to people is, what returns can you get me? How quickly can I see returns? What's the annual return I can expect? All of these things, but they don't consider the four main factors that they should be focusing on, which is our risk, our cost, our time in the market, and our behavior. If you can focus on those four things, then naturally returns will come. I promise you, returns will come. So that's it from me for the presentation today. Stay healthy, stay safe, and stay invested. That's from both me and the entire Sawa team. And I'm just going to move on to the Q&A now. So thank you so much for staying with me. It's been a pleasure to have you all. I hope the information has been useful. Let's see what kind of questions have had come through. So this is quite funny, actually. I know it was quite early on in the presentation, but the first question I'm seeing here is from an anonymous attendee, and it says, what is the annual return for the investors? So prime example of what's always at the forefront of everyone's mind. In relation to SAWA, what I can tell you, just to answer your question there, is that we would expect our annual returns to be between 3 to 7% based on a 10-year projection, subject to your risk level. So I'm sure we're all familiar with the terminology, lower risk, lower returns, higher risk, higher returns, and that is the same for the expected. So lots of SAWA related questions here. Deborah, if you're still with us, I'll get that answered for you quickly now. Yes, on our website, it does say one free call with a financial advisor, but you can reach out to us anytime. So please don't take that as final. If you have any questions, you want to discuss your strategy, the market, or anything, please get in touch. We'll be happy to help. Just trying to find some questions that might be relevant and useful for the entire audience. So one moment. Yes, SAWA does invest a Sharia compliant way of investing. We have a full globally diversified halal portfolio. So there's information that you can access on our website. If you go to portfolio details, you'll see the breakdown of each of the funds and any further information as well. So next question is from Mohammed, and he asked, what is your advice for a beginner who wants to start with Forex trading signals? So I just wanted to answer that because I'm probably not the best person to ask about Forex. It's not something that we include in our SAWA portfolios. The reason being is because it's very, very active, it's high risk, and it's quite speculative. So if you are a beginner who is looking to invest and want to trade in Forex, I would recommend just using a very small percentage of your wealth, money that you can play with and afford to lose, so that if it doesn't go well, it's not going to impact your entire overall returns and wealth. If you're looking for something that is slow and steady and long term, hit us up. Next question, what is considered a good duration for the long term? So we would classify long term really as anywhere from 7 to 10 years onwards. And this is also a good question because often when people think about their investments, or long-term investments at least, they might be thinking about retirement. So say you want to retire at the age of 60 or 65. It's important to note that this doesn't always mean that you have to stop investing at that time, because we tend to use life expectancy instead, which could be, usually we go off 95 years. When you get to retirement, it doesn't mean you have to liquidate your entire portfolio. You just simply need to start making annual drawdowns to maintain your lifestyle. So as a guideline, this is about 4% of your portfolio. So that then leaves you with a majority that can continue growing for you for the much longer term. And if anyone who is still with us this evening would like to get a bit of a retirement plan in place, or even if you have a specific financial goal in mind that you're working towards, then let us know, as these are the types of things that we can help with as well, to give you a bit of a projection and a breakdown as to how best to reach them. Alrighty, so I have a question here which says, do you build a customized portfolio based on nationality, or nationality doesn't matter? So No, this is not something that we take into account. Our investment portfolios are based on what's called modern portfolio theory. It's a piece of Nobel Prize winning theory, and it was actually developed by Harry Markovich, the investor that I meant, the economist that I mentioned earlier. So this states that the best way to maximize your returns based on your risk is through diversification. So really, diversification is the core part of our investment strategy. We have a question around security and SAWA. So let's address that. It's from an anonymous attendee, but the question is, what would happen to my money in the case that the company was to close? So this is a question that is very important, and I'm glad it's been asked, as we'd much rather you have that question answered than be left with concerns. So for anyone thinking the same thing, SAWA is fully regulated here in the region by the DFSA. We have offices in both Dubai and Abu Dhabi, and we've obviously been getting a lot of funding recently, growing exponentially as a company as well. So everything has been amazing on that front, but in terms of the money, that's actually held by Interactive Brokers in the US. So the funds are protected and insured by the SEC under SIPC insurance for up to $500,000 per account. So you're covered on all bases. You can check this out, by the way, about our security and regulation on our website. It's under one of the FAQs. So Rachel, if you do want to invest with us, we'd love to have you as a client. If it's not actually something you need to worry about doing yourself in terms of defining the appropriate portfolio, we have a team of experts, an investment committee that work behind the scenes to develop the portfolios. So they work very hard doing the backtesting analysis and all of the research to decide upon the best performing funds that are then built into our portfolios. The whole purpose of our service is to make the process much easier and cost effective. So from your perspective as the investor, it's super hands off. You haven't got to worry about trying to choose stocks, bonds, or anything else. We handle that as well as the ongoing management. So you can just invest and forget and rest assured that your assets are being looked after. Ehab, thank you very much. Great question. And this goes back to the very beginning of the presentation where we talk about the 50-30-20 rule. So the question is, how would you define high interest debt that you need to settle prior to investing? Because we do definitely encourage you to pay a high interest debts and loans down, because otherwise it's completely counterintuitive. You know, you're trying to earn 3 to 7% on your investments, but if you're paying really anything higher than 2 to 4%, we would classify as high interest. It's just immediately eroding your returns. So you want to try as best as you can to pay that down, and then all of the returns you get will be straight in your pocket. The different ETFs that you can invest in are again listed on our website. Go to the home page, click Why SAWA, and there's a full breakdown of the different portfolio types and risk levels there. As a fintech company, you know, we do try to make as much information available as we can online. So have a look there. You should see most of your questions answered. I'm wondering, I want to know how many investors joining us tonight are already SAWA investors, because there are many SAWA relevant questions. If I don't answer your question now, by the way, just to let you know, we will keep them on file, and either myself or one of the team will get back to you. for any risk changes, for example, things like this. We'll follow up as soon as we can on those. And Dana, the minimum amount to get started with us is as low as just $500. This is a starter plan that we introduced to allow investors to test this out, really, to get started with a very small amount, just get their feet wet, get comfortable and familiar with the process, make sure that they like the service and it's going to be the right fit for what they're looking for. So this is just the initial investment amount. There's no monthly ongoing contributions that you're having to commit to, and you can withdraw anytime. There's no penalties for that. This is a good question. So it's from an anonymous attendee, but he says, or she, that they have money invested with eToro, and how do we compare? So I'd like to answer this because it really addresses the difference between active and passive investing. And as we mentioned, active investing requires you to stock pick, well, choose your own types of investments, whether it's stocks, bonds, or anything else. Keep on top of the market. You're responsible for the day-to-day management of the portfolio, the rebalancing, manage your own risk, etc. Whereas SAR is very passive. So active might be focused on the short term. You're looking for those quick wins, the overnight significant gains, and it carries very, very high risk. Whereas SAR being passive, it's much more conservative. It's all about slow and steady growth over the long term. In fact, you might consider it even a boring way to invest compared to active, but it's definitely a bit safer. So I have a few minutes left, guys. I'll try and choose the best questions that you'll hopefully will find useful. Deborah, yes, we do have a panel of experts. That's, I mentioned our investment committee, but they aren't actively trading day to day. So their position in the company is to decide upon what they believe to be the best performing funds through analysis. They consider things like, for example, the historical performance, the liquidity of the funds, and of course, the low cost. But then once they are built into the portfolio, there's not any regular fund switches or trading. You're never going to get a call from someone at SAWA saying, hey, you know, now's a great time to buy and sell. Once they're in the portfolio, it is fixed, and it's about buy and hold for the long term. So it's just the experts who have the experience in finance and investing who are choosing the funds to begin with. Sorry, I'm just reading through these. As I said, they're all very SAWA relevant. Any questions around fees, guys? By the way, there is a full pricing page on our website, so please visit there. Everything you need to know is available. We're very transparent with pricing. So really, there's only one annual fee from our side. It's classified as an all-inclusive fee. There's no commissions. And the only other thing to be aware of is the ETF fee. So check that out on the pricing page, and you can see all of that there. So yes, Anonymous, we are a UE-based robo-advisor, but our core focus, as I mentioned, is diversification. So we invest across different sectors, companies, industries around the world, and we cover developed markets, emerging markets, the US, real estate, bonds globally as well. Middle East is incorporated within the funds already, but we likely wouldn't just purely focus on the Middle East because it's not diversified enough. So this is the last question I'm going to take because we're almost there for our hours up, and I know it's getting late into the evening, so I'm sure you'll want to go and chill out ahead of your Tuesday. And this says, what are the advantages of investing in SAWA versus putting my money in a bank that offers the same return and interest? So the reason I wanted to address this is because it's actually quite a common question. People living as expats very often do invest in their home countries, which may offer greater returns of interest with their savings accounts than the banks offer here. So countries like Egypt, India, for example, and we have a huge client base of both of these nationalities. And really we have to consider in the first instance where that money is being held, what risks are associated with it, and if you're planning to return to your home country as well, because if the answer is no, and you have no need for the money held in that country, whether it's INR or Egyptian pound, then you're also subject to currency fluctuations and risk. And for example, the INR has been depreciating against the US dollar for over a decade now. And if you are going to be needing to bring that back into dirhams, then that's most likely going to be outweighing any returns additionally that you're earning on your SAWA account. Sorry, on your savings account. So I hope that addresses your question, but if not, I'd need a bit more information and we can definitely set up a one-on-one to talk further. So like I said, guys, thank you so much for joining and staying with me tonight. I hope everything has been clear and useful. Any questions I didn't answer, we will get back to you on. We'll see you soon. Thanks so much, guys.